Marknaden skulle rasa och oroa sig mycket över Federal Reserve-debaclet i helgen. Så har det inte blivit, i alla fall inte än. Med oss för att diskutera räntemarknaden och vägen framåt har vi Valentine Ainouz, chefsstrateg for fixed income with Amundi Investment Institute. Very nice to have you back. We met a year ago.
Hello, nice to be here.
It's nice to be here in turbulent times. Maybe not on the markets, but when it comes to the Federal Reserve and the independence, it's been an eventful couple of days for sure.
Yeah. Now the Fed independence is a threat. It's a threat for the U.S. Economy, but the market doesn't react a lot. If we are looking at the Fed funds rate path expectation, the market is still expecting a terminal rate at 3%. If Donald Trump could effectively, heavily influence Fed decision, it is absolutely not a terminal rate at 3%. It's more a terminal rate between 2 and 2.5. The other point is that if we are looking at long-term inflation expectation remains well anchored.
Yeah.
And if the Fed is no longer attached to this inflation mandate and is more focused on growth and pushing rate lower, we could have some disanchoring of long-term inflation expectation. So this is not really something we are seeing right now in the market.
That's very interesting. If inflation expectations would go up if you didn't believe that the Fed has the situation under control in one way or the other. So we're not really scared. We're not really panicking.
No, right now the market is still thinking that the Fed will stick to its job and will continue to maintain inflation under control, and investors continue to think that the Fed will go into this direction, because a Fed that is not under control means that investors will remain very reluctant to buy long-term treasuries. They will ask higher yields to take a long-term position of US government debt. Because what does Trump want to do when he wants to push US interest rate down? He wants to be able to maintain a higher level of deficit for a long period. Because now if we are looking at the level of US deficit, it's roughly 6-7%. It is something quite unusual, given the US economic history, to have such level of deficit in an environment where we are at full employment. So they maintain this level of deficit because they are in an economic war with China. They have to push investment to be. They have to win this AI race. So definitely, Trump wants to have everything going into the same direction, more investment, and to lead the global tech sector. So and to do this, he needs to have a lower rate to be able to maintain this high level of deficit for a long period. Now, if we are looking at the cost of government debt of interest, it's above 1 trillion, and it's roughly 20% of the government revenues. So they definitely need to have a lower Fed fund rate to limit the increase in the average cost of US debt.
This plan in running the economy hot and keeping inflation at bay seems to be working. Today we got inflation data from the US that held steady at 2.7 in December, in line with expectations. Your thoughts on the CPI numbers today?
This is really a good news. And the impact of, because last year we have some concerns about the impact of higher tariffs on the US economy. And up to now, the US economy held very well. And the impact of tariff has been very, very limited. Higher cost has been absorbed by importers and exporters. And the higher inflation, the impact of higher tariff on consumption has so far remains quite limited. So it's really a good news for the US economy.
I saw some headlines after the weekend's turbulence. I saw some headlines selling Sell USA, but that's not what we're looking at. You seem quite optimistic about the American economy.
The US economy, I think, will continue to do well. We expect growth to be around 2%, but we have to keep in mind that it's a two-speed economy. We have a part of the US economy that is doing very well. Consumptions, driven by high-income households, remains very solid because of wealth effect. US Americans have never been as rich as today, but we have to know that 10% of the top highest income US households, they held more than 80%, 85% of US households' equity, and they account for half of US consumption. So it's really this booming of the US economy is really in the hand of high income households. And this booming of the US economy is also supported by AI investment.
But is it enough? Those are two very interesting points. But is it enough to have a small but wealthy, albeit wealthy, part of the population consuming? Is that long-term still? Don't you want a broader?
It's much more stable and sustainable when it is broader. It's why we could have positive news in moving into 2026. Because for me, there is two potential things. First, Fed fund rate cut is going to be very positive for the US economy. It's going to be very positive for US households with the lowest revenues because they are exposed to variable rate. And it's also very positive for small and medium-sized companies that are also exposed to variable rate. And we should keep in mind that we are entering an electoral year.
You can tell.
And we could already see that we are entering this year with a big announcement regarding some potential cap on credit card interest rate. And so we also want to buy institutional investor to buy single home. So we have now a lot of announcement on US residential market, because this is really a big issue for American. US residential market is today completely frozen. Sales of existing home are now back to level registered in 2008. So it's really a big issue. And US household is now not really affordable for the average American. The time for the first purchases has moved from 33 years to 40 years. So this is really a big issue for Americans. And also credit card debt is a big issue. We have the default is around 8%, and it's usually a default you have in a recessionary environment. So now Trump is really focusing on some hot topic for low-income consumers, but it's just because we are entering this electoral year.
Two questions. How efficient do you think it is? A measure like capping the interest rate on credit card, do you think it matters for the consumers, or is it only show and theater?
I don't really have understood so far how we could do this, but this is definitely positive for low-end consumer. The average interest rate for credit card debt is more now around 20%. 20%, and for the US household with the lowest revenues is even around 30%. So it's really a big issue, and it's really difficult to understand how interest rate and credit card debt could be so high versus the level of the Fed. It's like there is no now correlation or between the level of the Fed funds rate and the level of rates and credit card debt. So a part of the explanation of this differential is because of the deterioration of the credit quality for the US household with the lowest revenues. But for me, that's not enough. And I think Trump is right to look at this topic.
I just feel I'm a little bit surprised that you have a president dictating interest rates, even if it's on a credit card level. It's a little bit of a populistic vibe.
Of course. No doubt about this, but at least if some populist vibe is positive for people, we have to take it. So, of course, it's because we are in an electoral year. It was not the focus of Trump last year. It's really keeping this positive boost for the US economy to implement just before the election. But I think an interesting topic for the US is really the US residential market that is today completely frozen. But for many reasons, because of the level of mortgage rates, but also because of the lack of supply. So there is no just one explanation and one solution. For me, it's really a package of solutions that should be implemented. But for me, it's really a hot topic for US American.
But okay, you see growth being strong in the US this year. You see, albeit populist president stimulating the households that aren't doing so well. Hopefully consumption comes back. That sounds like a good year for equities as well, and for the US in general.
that this picture is good. If you have an economic activity that remains resilient and you also anticipate the Fed cutting interest rate, this is a really good combination for US equity. The negative point and the huge risk for the US economy for me is today the level of valuation that are today very, very tight. And this is not only an equity topic, it's a macro topic. If you have an equity correction in the equity market, you will have a macro impact because the equity market is today supported consumption. So for me, it's really important. So you have a very tight valuation. And the other point, if we have, and this is not our scenario, but if we have very, very an inflation that remains very sticky and the Fed that is not cutting rates, it will also have a negative impact on the US economies. For me, we have these two risks: equity valuations that are now very, very expensive, and as well sticky inflation and a Fed that is not cutting rate.
Well, quite interesting. Two interesting risks in a mainly positive scenario.
Yeah.
What we just discussed, strong market for equity, good times in the US. Could the gold keep on advancing as well? This can go hand in hand.
Yeah, for me, gold remains really a good investment and a good way to hedge this risk related to government debt. Because now we are talking about US debt and the Fed, but this question of central bank independency is not only a question related to the Fed. We have over the last year an increase in public debt and a decline in private debt. So this question of increasing government funding needs is not only a question for the US, it's a question for most of developed economies. Government funding needs are today increasing because of the aging of the population, because of the need to increase defense spending, and more specifically in the US because of the AI race between US and China. So definitely, this is not a story that's going to change in the coming quarters. Government funding needs will remain high, but the macroeconomic environment is changing. Between the subprime crisis and the COVID, we have a rise in government debt, but at the same time, we also have a decline in interest rate, and it helps to stabilize the cost of government debt. Since the COVID, we have at the same time a rise in government debt and an increase in interest rate. So now we have a lot of questions about to which extent the cost of government debt could rise. Is it a big issue for the coming quarters? My answer is no. We still have some room to issue on the very short end of the curve. Because during these very nice periods where rates were low and declining, government increase the average maturity of their debt, and they also lowered the average cost of their debt. So now we have some room to increase issuance on very short maturities, but this won't last for a very long time. But at least this is for the coming quarters, and this is what the U.S. Treasury is doing. It will issue more T-bills, and the Fed will as well buy more T-bills. So no big issue in the very short term, but definitely we have an issue regarding the cost of debt, but it's more for me in 2 years. But if government are issuing more short-term debt, it means as well there will be much more pressure on central banks, not only on the Fed, but also on other big central banks. It's very interesting to see the reaction of other central banks to the aggression against Jerome Powell.
Very interesting. I think one thing is certain. It's an interesting case for equities and for gold. One thing's for sure. We're not going to have a boring year.
No, absolutely not.
Please, Valentine Ainouz, it's wonderful to have you back here.
Thank you.
Thank you so much for coming.
Thank you.